That is the closing bell on Wall Street, and now it is Market Domination Overtime, sponsored by Tasty Trade. We are joined by Jared Blickery to get you up to speed on the action from today's trade. Let's start where the major averages ended up. We've got some red on the screen here. The Dow's going to finish down about 390. Your broad gauge, the S&P 500 down about 0.8%. Tech-heavy NASDAQ down about 0.9%. There were some different cross currents today. Trade, of course, front and center. Treasury Secretary Scott Bessent telling House lawmakers that the Trump administration could announce trade deals with some of our largest trading partners as soon as this week, but also did note that negotiations have not started with China. And of course, all this is coming before the Fed's decision tomorrow. We know President Trump has been applying pressure there. We also know that Jay Powell has signaled monetary policy is on hold. Now to Jared for a closer look at today's sector action. Jared.
Thank you, Josh. Let's dial up the Wi-Fi Interactive behind me, and I will show you. I'll begin with the price action in the Dow. We started off the day negative, didn't quite reach into unchanged territory, never got green, and then we finished the day lower, pretty close to where we started the day. And you take a look at the S&P 500. Pretty similar story there, down about 0.75%. And then the NASDAQ, that is down 87 basis points, just a little bit more. And if you're counting, that's 2 straight down days for the major indices. And then that follows that 9-day up streak that we had in the S&P 500. Nothing too worrying here, but we're going to talk about some technical reasons why the market might be pausing, Josh, you and I, in about 30 minutes. Here's the VIX. That has been trending up over the last 2 days as equities have been falling, but not a lot. I show you the year-to-date here, and you can see that 2-day up move is just a tiny, tiny blip, nothing in comparison to what we saw at the beginning of April. And then just taking a quick look at the bond market, here's a year-to-date of the 10-year T-note yield. That is down 3 basis points to 4.31%. Now let's get a check of the sector action. Only utilities finishing in the green there. That's a pretty defensive move. Healthcare leading to the downside. Saw a lot of weakness in biotech today. Consumer discretionary and industrials and tech also underperforming. And if we take a look at the NASDAQ, pretty red picture there. Not a lot of outliers to the upside. Looks like Chegg up about 10%, but Palantir 12% to the downside. DoorDash down 7%. Vertex down about 10%. And just taking a look at the leaders, you're going to see biotech at the bottom. Both IBB and XBI are biotech ETFs, and those are down about 5, 6, 7% apiece. Also seeing a lot of weakness in ARK, and if we take a peek inside the ARK Innovation Fund components, Tesla is a big one there, but the biggest loser looks like CRISPR, Beam, and then Shopify down 4%. Back to you, Josh.
Thank you, Jared. Joe Mazzola, Charles Schwab, head of trading and derivatives strategist, still here with me. Joe, earnings season rolls on. Waiting for AMD. That's going to hit the wires any minute here. I'm just curious, big picture, earnings season, what did you make of it, Joe? What were the lessons learned?
I mean, if you're looking at EPS beats, you're over 70%. That's pretty good. I'd say revenues come in a little bit lighter than than maybe hoped in terms of the beats there. It's the guidance, right? It's all going to come down to guidance. You've got companies like Ford that are pulling guidance or at least lowering guidance. There's a lot of companies across the board that just don't know what the next 3 to 6 to 9 months are going to look like. And as an investor, I think what you're seeing is investors are pulling back a little bit until they get a little bit more clarity, maybe not on the earnings front, but maybe how the trade and tariff policy maybe affect these companies.
So when AMD reports, you obviously on the call, there's going to be a lot of talk and interest about what does CEO Lisa Su have to say about the AI opportunity. Of course, another way investors play that AI opportunity was the Mag 7. Yep. I'm just curious, those Charles Schwab customers, what kind of retail investor interest are you seeing in those big tech names?
So those primarily are the biggest buys, right? Is the AI names. But I will say this. What we've seen in the past is we've seen AMD on that list, we've seen Broadcom on that list, NVIDIA on that list, but this time it was just NVIDIA. So it was really NVIDIA, Amazon, and Tesla were the 3 big buys, and we just didn't really see as much of the AI interest from, there are ancillary plays, right? If you look at like a Microsoft, that made the list as well. But in terms of what we would consider just kind of straight AI, it wasn't as much interest in this time around. Mag 7 really just kind of dominated the purchases.
Finally, Joe, I know you have to go. I'm just very curious. I know it's a little into the weeds. The margin balances for those Charles Schwab customers, what are the trends you're seeing there, and what does it tell you?
Well, what's interesting is you're seeing the margin balances go down a little bit. And I think what's interesting about that is it just kind of says that, look, if there were margin calls, people weren't stepping back and buying with both hands, right? They weren't kind of over-levering themselves and waiting for that next big move. If anything, they're kind of sticking with what they have and just kind of waiting for things to kind of play out a little bit before they start adding a little bit more. I don't think that's a bad thing. I think it's just something to be mindful of. It does kind of tell me a little bit that some of this momentum that has built up since that April 7th drop might be waning a bit. And I would keep an eye on things like equity ETF inflows. I'd keep an eye on, if you're looking at technicals, I don't know if you're going to talk about this later, but looking at things like divergence between the RSI and then maybe what you're seeing with the overall S&P 500. Those will give you some indicators as to whether or not the flows are continuing and the rally's got some legs.
Joe, I know you got a flight to catch, but it was great having you here, brother.
Thanks, Josh.
It was perfect. Thank you,
Appreciate
sir.
it.
Our next guest, no stranger to the ups and downs of the finance world. His new book is out today. It is aptly titled Surviving Wall Street, A Tale of Triumph, Tragedy, and Timing. It explores dramatic changes in investment banking over the time and his personal experience navigating and leading some of those changes. Scott Bach is the author and is also senior advisor at M&A advisory firm Greenhill Company, an independent investment bank. Scott, thank you so much for joining us.
Thank you. My pleasure to be here.
So the new book, walk us through it. When you wrote it, Scott, what was the point and purpose of it? What are you trying to accomplish?
I mean, the point is I looked at my career, the length of my career, and at the beginning of it, when I graduated from college, the Dow was under 1,000, which was lower than it had been more than a decade earlier. So kind of a dead decade. Interest rates were 20%, the federal funds rate. Mergers and acquisitions almost weren't really happening at all. Phrases like private equity and hedge fund and activist shareholder didn't even exist. And yet you look at what happened over the course of my career. I mean, you had, M&As now trillions of dollars worth every year. Private equity owns 30,000 companies. Investment banking is sort of pervades every single industry we've got, politics, sports, and all the rest. So it's been an amazing growth in the industry. But yet at the same time, more than half of the firms that existed when I started are gone, long gone. So what's the what's the drama behind that tale that has that explosive growth, and yet it's such kind of a Darwinian industry that most firms don't survive, and that's why the title of the book is Surviving Wall Street. And most of their CEOs have a lifetime that's even shorter than those firms. So it's that's the theme of the book.
Scott, I happened today to be going back and forth with a good friend of mine, very well-known, very successful venture capitalist. And I was talking to him, and I said, if you were giving advice to a young American kid, this person, they're smart, they're talented, would you say to go work on Wall Street? And I thought his answer was interesting. I want to run it by you. And he said to me, Wall Street matters. He said, finance matters. He said, but you know what? If I was talking to that young American kid, smart, talented, drive, a lot of ambition, I would say, he said, go learn tech and go learn how to build. He said, that is the smarter move. What's your response to that?
Look, I think for a lot of kids coming out of college or something, Wall Street's still a great place. And not necessarily to spend a whole career, 40 years like I did, but maybe you do something else. I mean, we have people who passed through Greenhill over the years. I mean, one guy's COO of a National Football League team. One guy's got his own clothing brand and company that he built from scratch. And so there are a lot of things you can do, but I think to have that building block of how are things valued, how do you make value go up and down through strategy? How do you maneuver through crises? I mean, you learn a lot of that in Wall Street that's useful, whatever you end up doing.
Let me ask you a broader trend here about M&A, because saw a report today from Reuters, and I want to get your take on it. They noted the number of M&A contracts announced across the world fell in April. They said it's got lowest level in more than 20 years. In the U.S., they pointed out, just 555 deals were signed last month, the fewest for any month since May 2009. You hear those stats. I mean, I'm sure you already knew them, familiar with them. What do you make of it?
I think, look, it's an overused word right now, but it happens to be the right word, which is uncertainty. And people particularly don't know where the policy is going to be in terms of international trade. And, you think about a huge portion of M&A over the last couple of generations, that period of that explosive growth I talked about, really was cross-border deals. I mean, it's essentially, I think of it this way. When I was a kid, every little town had its own newspaper, had its own bank. Every region had its own soft drink brands, its own ice cream brands. And what happened through M&A activity over the decades was, the creation of national and then international brands. And, if that's going to be shifted into reverse, I think that's a real, challenging unknown for the market to figure out, how do I invest in that? Particularly, how do I invest the big dollars involved in an M&A deal? Or do I just hold off? And I think that's what most companies are doing right now.
If you saw more clarity and certainty on trade deals and then you saw a pickup in M&A, Scott, Are there certain sectors where you would expect to see more activity out of that? I mean, healthcare, energy, tech, where would you expect to see it?
You know, I think it'll be more across the board. I mean, almost every industry is going to have to adapt to new policy. Clearly, we're going to have somewhat of a different trade policy, and almost every one of those industries is going to figure out, how do I adapt to that? Do I need to have more manufacturing capability in the places where I'm selling? You know, do I need to shift the global portfolio of brands that you're selling, or products that you're selling, or markets you're selling into? And I think companies are going to have to really readjust, but they don't know what to adjust to quite yet.
Final question, Scott. You are well known for this celebrated career on Wall Street. I think you also became well known for playing this role in the crisis at UPenn in 2023. Mark Rowan of Apollo, our parent company, right, called for your resignation. You did resign. It was all about the response and reaction, of course, to the anti-Semitism on that campus. What did you learn from that experience?
You know, I learned a lot of things. I would say one of those things is that boards in the nonprofit world, including major universities, are very much like boards in the corporate world. They're not really ready for a crisis when it comes, and it becomes very challenging to build a consensus on that board and figure out what you need to do. And, in the nonprofit world, people have strong opinions, right? They didn't get on those boards thinking they were going to be embroiled in controversy. So when it comes, it's very challenging to figure out, how to drive the institution forward. And that's kind of why I stepped aside. I think I got to the point where I didn't think I could lead that board. I'm not sure anybody could have really, but I think my leaving was a bit of a wake-up call for that board to sort of unify and come together and figure out how to really work their way through what continues to be a very difficult crisis. I mean, frankly, more difficult than even when I left 18 months ago.
Why do you say that?
Well, you look what's happening with, Columbia, with Johns Hopkins, with Harvard. I mean, you see significant layoffs happening at a number of places because government money's being withdrawn. There's a threat of a endowment tax, potentially even tax-exempt status, which would really be, I think, the nuclear weapon, because then not only do you end up having to pay property taxes, and think how much land Columbia, Harvard, Penn, et cetera, own, but you also lose the tax deductibility of alumni donations, and I have to think that's going to really make those dry up.
Scott, thank you so much for joining us today, and congrats on the book.
Thank you very much.
Upstart reporting a revenue beat for the first quarter. The AI lending platform also posting adjusted EBITDA of $42.6 million. Here to discuss the quarter and more, let's get to Upstart CEO Dave Girouard. Dave, you just reported results. Heading into this point, we should remind the audience, listen, the stock was down about 25% this year. You were up, though, about 100% in the past 12 months, Dave. But walk us through the quarter. I'm interested in what you're seeing in the business.
Yeah, thanks. Great to be here. A few things about the quarter, I'd say. First and most importantly, because we have, more than 100 banks and credit unions and private credit investors on our platform, the credit is performing exceptionally well. And it has been for quite some time, all the way back to Q3, Q4 of 2023. All of our cohorts are performing better than expectations. And we don't see any, I think it's important to kind of say in the world of today, we don't see any weakening in the consumer credit performance. So that's number one. That's the most important thing. Secondly, we're in growth mode. We grew our transactions 89% year on year. We grew revenue 67% year on year. And you mentioned our adjusted EBITDA. The margin on that was 20% for the first time in 3 years. And then lastly, and also really importantly, our business is pretty rapidly diversifying. About a third of our core loans and our core personal loan product were super prime loans. That is, people with credit scores higher than 720, and that means that's a segment of the market that we weren't even in not very long ago. And also, our home product is growing, or grew, I should say, 52% quarter to quarter, and our auto products grew 42% quarter to quarter. So very rapid diversification, and feel like we're doing exceptionally well right now.
Let me ask you, Dave, though, one issue, and the stock is under some pressure here, the revenue guide here for Q2, it does look like it came in 225. The street was more like a 228. Were there certain puts and takes that maybe analysts hadn't factored in?
We provided annual guidance, and of course, this is the first time we're providing Q2 guidance, so people will kind of extrapolate that as they wish. And we are, of course, being reasonably cautious given there's a lot of unknowns out there. Our guidance does not assume any rate cuts from the Fed, which I think is a good place to stand, and doesn't assume any massive change in the macro from where it stands today. But we'll always take a position we feel good about, and analysts can be a little off that. But our business is growing quite rapidly. It's on the very edge of being GAAP net income profitable. And the credit's performing exceptionally well. So I couldn't be happier with the actual numbers.
I thought you do have interesting line of sight there, David, into the consumer. And you're saying, and correct me if I'm wrong, you don't see big changes versus, let's say, 6 months ago or 12 months ago right now?
No, we don't. In that time frame, the consumer financial health has actually improved pretty significantly. What we call the Upstart Macro Index is how we measure that. And it's really, in the grander scheme of the last 12 months or so, come down a lot, which is a good thing. It means the consumer health is getting better. Now realize, of course, that our interests are a little different than, say, a retailer who just wants consumers to keep spending. In our case, we like consumers who are either saving more, spending less, being responsible, because that's accretive to credit performance. So our interests are a little different, but from that perspective, consumers are actually doing quite well.
And Dave, listen, I got plenty of economists coming on the show. They tell me the odds of a recession are rising. If we did see that, Dave, if the U.S. economy did slip into contraction, that would mean what for your company?
Well, again, it's a bit of a mix. It means, and it depends how it plays out. But a modest recession where GDP kind of shrinks a little bit, as it might have last quarter, might be right now, doesn't actually mean much to us. What we really care about, again, is consumer financial health. And oftentimes, in a recession, what's going on is consumers are spending less. That can be net good for us. So generally speaking, a recession's okay unless it leads to pretty dramatic increase in unemployment, which is, of course, negative to credit. But 4% unemployment to 4.5%, that's not really all that meaningful to us. If it went 4 to 8% or 9%, that is meaningful to us. But we've also gotten really good. Our technology is getting better and better at tracking and responding to changes in the macro environment extremely quickly.
You're talking about the tech, Dave. You are an AI lending platform. I'm curious, how do you see the technology evolving? If we're talking 12 months from now, David, how does it evolve, and how does it evolve in ways that benefit you?
Well, the way it's been on is it creates more accuracy of risk models. And that means more separation between good borrowers and bad borrowers, more automation of the process. Whenever these models get upgraded, it generally leads to higher conversions through our funnel, and that's how we grow. So what I expect to see in the next 12 months is our core product will continue to grow fairly rapidly as we're expanding into new segments. And then our newer products, as I mentioned earlier, the auto product, the home product, are on very robust growth paths. So we're getting more diverse. We're applying the same AI technology to more segments. And so we're at the very early days. I think just the segments we're in today, just the products we have in the market today, have years and years of growth in front of them. And our goal, frankly, is to be #1 in market share in every category we're in. And I think we have the technology and the team to do just that.
Dave, thank you so much for joining us today. Appreciate your time, as always.
Thank you.
Well, Rivian out with their latest earnings report. Let's get to Yahoo Finance's Praz Subramanian with the latest results there. Praz.
Yes, Rivian reported better than expected results and posted a second straight quarter of gross profits, but Trump's tariffs on auto parts will push Rivian's CapEx higher. So the good part, gross profit of $206 million, a second straight quarter for the company, and actually unlock an additional $1 billion payment from VW as part of their joint venture. So good news there. But the uncertainty from tariffs means the company cut its 2025 delivery outlook to 40 to 46,000 units and will push that CapEx higher by $1.8 to $1.9 billion this year. Rivian maintained its 2025 adjusted EBITDA loss projection of $1.7 to $1.9 billion. So that was good, but they kind of added it there to the CapEx. Now for Q1, reported revenue of $1.24 billion versus $981 million estimated, and posted an EPS loss of 48 cents, narrower than the 92 cents estimated. That's an EPS not adjusted there.
Thank you, Praz. Appreciate it, sir.
You're welcome.
AMD's first quarter results, they are just hitting the wire. Let's take a look at those numbers. Shares up about 7% initially in the after hours. Q1 adjusted EPS 96 cents versus the estimate of 94 cents. So that's a beat on the bottom line. Revenue $7.44 billion. The street was at $7.12 billion. So beats on the bottom and the top. Just looking at Q2 revenue, what they're calling for, between 7.1 and 7.7 billion. The street was closer to 7.23 billion. And they are are modeling Q2 adjusted gross margins 43%, and they say that it is inclusive of export charges. Remember, the stock was under some pressure here, of course. It was down year to date about 20% heading into this print. It was down nearly 40% over the past 12 months. We're higher here in the after hours. Big picture questions, obviously. How does AMD talk about the AI opportunity ahead? Any more color and commentary around the Trump tariffs and their impact on this company's bottom line? Computers we know exempt from Trump tariffs, but the administration saying could impose duties on semiconductors. China angle, AMD in April, remember, talking about this Trump administration instituting tighter export controls, so you can be sure there'll be more questions about that as well. And of course, always more color and commentary about the PC market, how that they see that evolving over 2025 shipments ahead. We'll stay on it. Stick around. Much more market domination overtime. That's coming right up. Let's do one more check on the market sponsored by Tasty Trade. Stocks closed the day lower here. Just look at the major averages. The Dow down about 390 points. The S&P 500 down about 0.8%. And the NASDAQ down about 0.9%. Of course, trade, as always, was front and center today. Treasury Secretary Scott Bessent did tell House lawmakers that the Trump administration could announce trade deals with some of our largest trading partners as soon as this week. Did also note, though, that negotiations have not started with China. And, of course, it's all coming before the Fed's decision tomorrow. Yahoo Finance is bringing you live coverage, meanwhile, all week long from the Milken Institute Global Conference in Los Angeles. Let's get it back out there to Brian Sozzi as he catches up with Robin Vince, BNY CEO.
Yahoo Finance descending on the Milken Conference once more. Joining us now is BNY CEO Robin Vince. Robin, good to see you. Feels like I just saw you a couple months ago at the World Economic Forum.
Yeah, it wasn't long ago, Brian. It's great to be here, great to be with you.
Last time we talked was actually on your earnings a couple weeks ago, and you made a great point that there's a lot of risks and uncertainty right now because of the trade war. But the market has rallied back pretty aggressively. Where's the disconnect?
Well, I think there are a few things to note. So number one, we've essentially made a round trip in the stock market since the election. If you look at where the S&P is today versus the S&P the day before the presidential election, and actually it's about the same level as it was on Liberation Day. So there's a lot of talk about the anxiety in the stock market, and it's understandable because there's a lot going on. But actually, in terms of actual levels, we're sort of unchanged. Now, of course, the world's a complicated place right now, and there is a difference between the sentiment in the economy, which is pretty poor, and the facts of the economy, which have actually held up pretty well.
Then is the market wrong? If conditions are poor, maybe the market just has this whole thing not correct.
Well, the market looks through to the future. It always does. And so the question is that the market's trying to answer, which is maybe a little different than the question you and I are answering. It's not where are we today, but where are we going to be? And so Secretary Bessent's here at Milken as well, talking about the three legs of the stool of the administration's policy. It's about trade, including the non-tariff barriers, so it's not just about tariffs, also about deregulation and unlocking business potential, and then about taxes. And so what we're seeing, I think, with the market moves is the first leg of the market down was focused on one of the three legs of the stool, but there are two other legs. And so now the question is, the market's looking and saying, I wonder how this is going to come together. Now, what will be most helpful would be a really good trade deal, because that's going to start showing the path if that can happen. And I think the market would take a lot of confidence from that. If we don't see that over the course of the next couple of months, the market's probably going to start to question that again.
Is the market too optimistic on a trade deal?
Well, you know, the market's looking at more than just one thing, and we all should look at more than one thing, because the ultimate question here is, how's the US economy going to do over time, and are those three legs of the stool going to come together to be successful? Now, I was just in Europe 2 weeks ago, I was in the Middle East last week, I was in India last week as well, really getting out there, connecting with clients, talking to our clients, understanding how they're seeing the world, and so it also depends on where you are and who you talk to.
A lot of course, big international contingent here at the Milken Conference, as always. A lot of CEOs that I talk to, global CEOs, they are concerned that there has been damage done to the US brand because of everything happening on trade. Do you share that sentiment?
I think it's a little bit more complicated than that. We saw in the first Trump administration that there was just a change of approach, and some of the European allies, foreign partners just weren't used to that. We're seeing the same change of approach again. And this time, there's definitely a question on people's minds, but it is different region by region in terms of, okay, what does that mean? What does it mean for the dollar? What does it mean for treasury markets? What does it mean for the US as a reliable global partner? And you get different answers to that question as you travel around the world. There's clearly more anxiety in Europe. That's probably peak anxiety on this question right now. I think in the Middle East they were a little bit more sanguine, to be honest, and that reflects their place in the world, both geographically and geopolitically.
How disruptive would it be if the international community begins to lose trust in the US brand and they start to sell treasuries, for example?
Well, you have to remember, what do treasuries represent? They represent the safest investment on the planet. And there's a reason why they are considered to be the risk-free go-to asset. And it's all very well to say, hey, let's go and find another one. But there are a lot of things that underpin that US resiliency, that trust, the legal system over a long period of time, all of the big financial institutions in the world that help that market, the depth, the liquidity, the predictability of the process. And so there are a bunch of different legs underpinning that stool. There are many countries that would love to be able to replicate that, but it's a little easier said than done.
Is the US Treasury bill, is it still risk-free? Is it still safe?
So it's always the case that any asset in the world has some element of risk or uncertainty associated with it. There's no such thing as the absolute perfect answer. You can buy gold, but somebody could steal the gold. You can buy treasuries, people can call into question aspects of the treasury market. The right question, I think, is what is the most risk-free asset in the world, and what is the one that offers the liquidity associated with it? We do a lot of things for the US Treasury market. We have a very good vantage point on that. We're settling over $20 trillion a day of US Treasuries on our various different platforms as a company. And I think you can see with the volumes, with the movements, that the market is a very robust market, and it's worked really well.
Are things still functioning correctly?
100%.
Have you seen signs of stress at all?
The only thing that we've seen, that other market participants have seen, is that there has been at various times reduced liquidity because of the volatility in the markets. But that's normal for markets, because when you have a fast-moving market, people are going to make bid offers in smaller size. The liquidity at the top of the order book, the depth at the top of the order book, that's going to reduce. It has. Did it for equities as well as for treasuries. But the underlying infrastructure, the rails of the financial system, they've been rock solid, and they haven't wavered through the process at all.
And of course, this week we'll have a key Federal Reserve meeting. You've of course been in this industry for a while. You've seen a lot of Fed moves, things they have done and haven't done. Do you view right now as the most challenging, or one of the most challenging periods for the Federal Reserve?
Yeah, I think that falls
outside the great financial crisis, of course.
I think that falls into the question of, it always feels more challenging to deal with a situation when you're in the middle of it. And then with a little bit of the distance of time, you sort of forget how challenging the last one was. We've had a lot of challenges. COVID was, I'm sure, a very challenging time for the Federal Reserve. It was only a few years ago. So we have these periods, and each one, when you're in it, probably feels like the worst. But the Fed's having to navigate this. It's clearly tricky. And there is an issue here, back to this point about the facts of the economy compared to the sentiment of the economy. Sentiment is not great on the economy because the administration is taking some difficult decisions that are creating some resets, create anxiety on the expectation and hope of a future payoff from that. And if that's successful, it could be a great strategy, but there's an if in that statement. So the Fed's navigating that. But the reality is the economy's actually been performing. And so you saw that with the jobs report last week. GDP was obviously more negative, but there's expectation that it'll rebound in the second quarter. So, the Fed's probably, be my expectation, that the Fed will do what they've indicated they're going to do, which is wait for more data and wait to see how things develop. There's no particular advantage to them to go rush ahead of the game, although I understand that that's a complicated question, lots of points of views.
Lastly, Robin, amidst this turmoil in markets, have you been able to push through your business initiatives as a CEO? I can't tell you how many leaders I've been talking to where they've had to put a halt on that big project they're working on, or reassess how many employees they have in their business. I know you're pivoting to more of a platform-based company. Have you made any changes?
Well, we've been forging ahead. I mean, our people are excited about the change that we are on as a company. We're serving clients. Now, clients want more things from us actually at times of uncertainty. They want more help, they want more advice. They want to be able to use our platforms. As they challenge their own expense models, there's outsourcing opportunities for us because we're a platforms provider. So the short story is we're going through a transformation. Of course, one has to be careful, one has to prepare for the worst. We're all risk managers at heart across all industries, but particularly in the financial services industry. But we're plowing forward and we're optimistic about our business model, and we feel we've got the right platforms to help our clients move forward. So that's exactly what we're doing. We're focused on going forward.
All right, well, good luck at the conference. We'll talk to you soon. BNY CEO Rob and Vince, thanks for coming on, appreciate it.
Good to be with you. Thanks, Brian.
All right, guys, back to you.